Good morning, Facebook. I'm Jill Malandrino with the Voice of America, and this is Nasdaq's Facebook Live. Joining me today is Chris Dearborn. He's the Managing Director on Nasdaq's Market Intelligence Desk. Chris, thank you as always for joining me.
My pleasure.
Pretty
Thanks
interesting. Every month we're always saying we're hitting new all-time highs. What's going to bring this market down? Well, we had a headline number on the employment report, which was disappointing, and March and April were revised lower. But you saw something in the report that could be positive.
Absolutely. So everyone's focusing on the top line number, which was 138,000 jobs created for the month of May, which is significantly lower than the expectations. And you saw the downward revision for the 3-month, down 66,000 jobs over a very disappointing March and obviously a disappointing April number. So people are thinking off of that number on the top line that there's really not a lot of jobs out there. The companies aren't hiring. But if you look at the underlying numbers within the entire report, you want to look at wage growth, which is also static, if not a little bit disappointing there on the growth, is what they call the U6 number. And that's not a number that's widely publicized. It gets picked up here and there. The current administration in the White House made a big deal about the U6. They kind of want to use that as their main goal. So if you look at the U6, what that does is it takes into account the entire unemployment basis for the United States. So it includes the unemployment number based off of the number of jobs created. So what you have there is people who are not looking for work, who've rolled off, the people who are working part-time, and the people who are working full-time, and people who are looking for jobs. And that number has been decreasing steadily since January. So that is a very positive sign that this U6 number is really where the underlying base is. So it means that more people are going back to work, more people who are working part-time are actually taking full-time jobs, and those who are really working and looking for work are able to find it. So the unemployment number, which comes out every Thursday for new claims and the continuing claims, has been under 300,000 for well over 110 weeks. And this non-farm payroll number, kind of, you look at it and you say, well, you know what, if that number is so good, but there's not a lot of jobs being created, what's happening here? And what you're seeing is people coming back onto the register who want to work, but there's not enough quality jobs for people. And that's why the wage growth has to start to tick up. Once wage growth starts to tick up, then you're going to see companies starting to pull people in, looking to pay more for the talent that they have, to preserve the talent that they have, and also to get better talent by paying that extra wage to bring that person in. So the pool is there, but there's not enough right people in that pool, and that's why that job number on the top line doesn't look so good.
All right, well, let's talk about market leadership here. Nasdaq Composite up 15.2% on the year, trading all-time highs. It's versus the S&P up at just about 8%. When we think about Nasdaq Composite, we think of tech stocks, but the leadership and what we're seeing hit 52-week highs is really a well-rounded mix of names.
It really is. So when you think Nasdaq, you absolutely think of either tech or biotech, and that couldn't be farther from the truth. The Nasdaq 100 is an index that's composed of the 100 largest companies listed on Nasdaq that are not financial companies. So you would think immediately Microsoft, Intel, Cisco, but you also have companies like Apple, Amazon, Facebook, right? Basic tech companies, but also with the consumer name. But then you have companies like Starbucks, Kraft Heinz, Mondelez, makers of Oreos, right? These are things that are found in everybody's cupboard. All of these companies, broad-based, are making all-time highs. So what you're seeing there is that this rally really has legs. It's broad-based across the board, and all of these larger cap names are the leadership to make us go higher. And even today, after May, the first couple of days of June, even with a negative report, according to The Economist, markets are making all-time highs again today across the board. And that's from small cap to mid cap to large cap. The large cap is going to lead this market higher.
Well, it's really interesting because we have sell in May and go away, which clearly did not prove to be true. Even when we had that big drop on May 17th, we repaired those losses by the end of the week, traded at all-time highs, following through this week on a disappointing headline number with jobs. We come into what's called June Swoon now, which is a newer term, but typically June is a month that ends lower if it's trading below its 200-day moving average. Now, if you take a look at an S&P chart, it's pretty clear that it's trading way above that 200-day moving average. And between what you're seeing on the technicals and then what we're seeing on the fundamental backdrop with large cap leadership, I don't know. It looks like June Swoon's really going to be challenged here.
You're going to have some very high volume days coming this month. You've got index rebalancing in the third week of the month and then quarterly rebalancing at the end of the month. So the Russell is going to rebalance their family of indexes. They're going to have the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600 also rebalance on that same day. So you're going to have a number of stocks trading at the end of the day with high volume prints, which is going to be one of the highest volume days of the year, if not the highest volume day of the year. So what that means is if stocks are trading above their 200 moving day average, indexes are going to rebalance upward as opposed to downward because they're market cap weighted. So as all these stocks that we talked about, which are large percentages of all of these indexes, increase the market cap, you're going to have to buy the appropriate number of shares to make sure that weighting within those index, and thus the ETFs that drive that movement, are correctly weighted. And they do that at the close of that day. They call it an NAV, or net asset value, like a mutual fund. And they need to get that last sale to plug it into their algorithm to make sure that the indexes are properly weighted. And if these stocks keep moving higher, they're going to have to buy more.
Right. Well, as a retail investor, what do I do? Do I have to do anything on that day, or do I just...
Nope, a retail investor,
Yeah.
if you're invested in ETFs that are following these indexes, you're going to capture that move regardless. You know, a good sign is, do you want to watch the underlyings of the stock? You look at the larger names that are involved in that ETF, and you get a very good idea where that ETF is heading. Apple's making all-time highs almost every day. Tesla, Netflix, Comcast, Priceline. Pick your stock. They're all acting well. Follow those stocks. You see where your ETF is going.
I love your new acronym,
Yes,
FATMAN. I love that.
I'm not talking just about me. Facebook, Apple, Tesla, Microsoft, Amazon, Netflix. All these stocks here on Nasdaq, all making all-time new highs.
All right. Well, thank you very much, Chris, for joining me. And thank you, Facebook, as always, for joining me. I'm Jill Malandrino with the Voice of America, and this is Nasdaq's Facebook Live.